All right, good morning, everyone. It is 8:43 on the morning of December 7th, 2022, and this is my pre-market strategy session. The title to today's video is "A Day That Will Live in Infamy," and really, that's not so much of a commentary on the market, so much as it is the anniversary of the attack on Pearl Harbor that I guess you could say provoked the U.S. to enter into the war in the Second World War and brought us to declare war against the Japanese, which the Japanese, having allied with the Germans, also brought us into war with the Germans and the European front. So we had two main fronts that we were, or two main battle areas that we were participating in. That is the South Pacific and Europe. And so to any surviving World War II vets out there, my grandfather was a World War II veteran. He flew bombers in the European theater over Germany. And God bless him, he's not with us anymore, but he's a great guy. He's just a great guy. And there's a reason that generation that fought in World War II was known as the greatest generation. It's because they're brave, very brave, and really set the tone for the next 60, 70 years of prosperity, global prosperity. And anyway, what happens in the market today? Well, what I'm keeping my eye on is one of two things. So here's a gap. The top yellow dashed line here is at 276.01, and the bottom dashed line is at 267.76. So if today we start breaking down below that 276.01, I expect that to actually act as short-term support for perhaps a day or two. But then, so what I'm looking for here in the next couple days is for price action to come down, maybe break down below it, then rise back up above it again, and then another breakdown below it puts the bottom of the gap, 267.76, solidly in play for the next spot to test. And I do expect to see, if we break down below this 276.01 within the next couple of days after breaking down below it, I do anticipate seeing a single one day bearish move all the way back down to this 267.76. But until that happens, I can't trade it. You gotta trade the chart in front of you. So what's happening here now is, you can see there's this, let's see, roughly it's almost been 20 days, which is 4 weeks, a month roughly, of trading in this consolidation zone right here. And so the Qs are coiling up for some kind of a move, the next move. Now, the most likely move is going to be a bearish move, because the trend is bearish. Here, this is a neckline to a head and shoulders formation that was formed. And that's the trend. This is a support and resistance line. The top line here is a support and resistance line. And so what I'm expecting to see is what I really think is going to happen is, here by the 19th of December, we will have a decisive move either to the bottom of the channel or above the channel. And if it goes above the channel, I think we'll see a short-term, meaning the next 6 to 12 weeks will be bullish and will break out of this pattern just to set ourselves up for the next bear leg down. The sentiment out there is just so extremely bearish, and bearish for a good reason. Here we have the 10-year, 2-year spread making all-time lows, making new all-time lows here. Yesterday, it closed down, let's see here, at 859 basis points. That is, according to the history of this chart, which goes back to the 1980s here, we'll go back, this is a 12-month chart. So this goes all the way back to January of 88. Actually, you know what? That's not right. That's the end of it. So let me just go to the 1 month here. In the end of this chart, this is a 1 month chart. So the data goes all the way back to February of 88. And so in historic reference here, an inverted yield curve can be inverted for anywhere between 6 and 18 months. And it's not until the inversion begins to normalize again that we see the real market crash. So what that leads me to believe is that while the yield curve is inverted and even going further into inversion, the equity markets can remain bullish. And in fact, it's not until the last 2 or 3 months or so that we even start to see the top roll over in the equity markets. In 2001 and 2007, let's see, in 2007, the market crash really kicked off in June. And I think the equity markets just only started to just roll over, a top was formed only 2 months prior to that. And the same thing is true with the 2001 dot-com bubble. So we could, even though, I mean, this looks horrible, and then actually let me pull up the PMI. I'll pull up PMI on a different chart here. Yeah, it's so annoying. Okay. Oh, and it got rid of I forgot to save. So let me put a mark at the 50 line here real quick. So there's the 50 line, and the purchasers. Purchasing managers index is it's a great leading indicator, and essentially anything below 50 is considered a contraction, and an indicator for an economic contraction. And so, yeah, here we are down at 37, which is extremely low. You can see here in 2020, the PMI was a low of 32.90. And here we are at 37.20. So we're near the low of when all the shutdown happened. So there's no purchasers management index was like there were no purchasing. There was very little purchasing being done. And we're approaching that now in a fully open economy. So yeah, looks terrible, bleak, horrible, right? Same thing, the 10-year, 2-year spread, new all-time lows, at least since 1988. We've got a 10-year that's yielding 859 basis points, actually as of right now, 822 basis points less than the 2-year. Totally backwards, totally inverted, completely, right? And there are all sorts of parts of the and actually, I'll go to it here. Let me go to my large caps and stuff, and we'll go down to the yield curve here. So the 3 month right now is still yielding less than the 1 year, but the 2 year is yielding less than the 3 year. The 5 years yielding less than the 2 year. The 10 years yielding less than the 5, 2, and 1, and and less than the 3 month. The yield curve, aside from the 10 year and the 30 year, as of right now, the 30 year is only yielding 7 basis points higher than the 10 year. So it's almost inverted as well. The entire yield curve, almost the whole entire yield curve, aside from a couple of adjacent bond yields here, is inverted. That is a sign of the bond market always gets it right. So there's a flight to safety. People are buying the 10 year, they're buying duration, and they're buying it over the short term because they see a safety play happening here. They see the ability to put their money somewhere. The 10-year is considered the risk-free rate. The yield on the 10-year is considered a risk-free rate because it's so dependable. And there are people who are willing to buy bonds that yield 3.5% over the next 10 years because they anticipate that being better than what they'll get over certainly the next 3 months, 1 year, or 2 year. And right now the 5-year is actually still higher than the 10-year also. So that's another part of the yield curve that isn't quite inverted yet. But yeah, that is not good. There are a lot of investors, institutional types out there who are piling into these safety plays in order to weather the storm, the economic storm that's coming up. So let me get this back to my indicators here. I think I had that on, I had it on the 10-year. So yeah, here's the PMI. It's at 37, which you could actually kind of consider, you could kind of call it negative 12.8 because below 50 is considered a contraction. And it's approaching lows that we saw in March of 2020 when the economy just shut down. Here we are in December of 2008, where, let's see, it was at 32.5. Where was it over here? 32.9 in 2020. 32.5 was the low over here in 2009. In the dot-com bubble, it was 35.40. So we're within a stone's throw of getting to as low as the dot-com bubble. So tech is going to get hammered, right? It's going to happen. But when is it going to happen? That's always the big question. Because, the market is the only place that you can be early and be wrong. Especially if you're going to buy something that's a leveraged product or has time decay like an options play. And there's nothing more than the market. The market just loves, the equity markets at least, love nothing more than reversing on bearish sentiment and climbing up on bearish sentiment. And so in the short term, in the very short term, I'm actually bullish until the roughly the end of February to the middle of March, in anticipation of this sort of time of the season. The middle of December to roughly the middle of March is just traditionally bullish on the equity markets. So what I think is going to happen is that we're going to get, I think this gap is going to fill sooner rather than later, and then we're going to take off to the upside on who knows what kind of news. I mean, who knows? You know what I mean? But it's going to be a short-term thing. Now, that's what I think. Now, that doesn't mean that's how I'm going to try and trade it. What that means is that I can be either congruent with my bias or contrarian to my own bias, which is something that a trader has to do. A trader, a really great thing for a trader to do is to be completely and totally unbiased and not have any sort of anticipation of what's going to happen at all and just react to the market movements. But we're all human. And being human and being, sort of economically minded and sort of market forces minded, we all have a bias. And so for me, I've found that identifying my own bias and then trading against it, being like, okay, my bias is wrong. I'm going to make money trading against my bias. And I'm comfortable with doing that. And there are other times where I'm like, okay, my bias is correct and I'm going to trade congruent with my bias. Unless I suddenly decide, obviously, that I'm wrong, my bias is wrong, then I'll cut the losses. But otherwise, yeah, I'm just looking to make gains against my own bias. So around about the 19th of December is when we'll find out exactly what this thing is going to do, if it's going to bottom out and move up or if it's going to just start crashing. So, yeah, we'll see. Let's see, I think West Texas Intermediate here. Let me go over to my risk range plays. West Texas Intermediate is acting bearish. Yeah, okay. That's a good thing for the fight against inflation. I think this also, I think, is short term. I think that It won't be long until we see West Texas Intermediate rearing its head again to the upside, and crashing up again, and then that sets off the inflation bells. Energy input. Energy is input to everything. Just everything, and so and the Fed is still hawkish. The Fed is still talking about rate hikes, and you don't fight the Fed, right? In the meantime, I think what the narrative is going to be is, oh well, the Fed is less hawkish, and that means more dovish, which means more risk on. Not, and I think that's what's going to carry us through until the beginning of next year, into 2023, maybe into the first quarter. Certainly, most likely not into the second quarter. I can't see that happening. But then, whenever this yield curve starts to normalize again, that's when we will really see the big crash. And I think a leg up before the next big crash will set things up. That'll clear all the bears out. And if we start breaking through, which I anticipate that we're going to break through levels like this, the 334 on the Qs, and that'll really give the bears a heart attack and everything. Anybody that's trying to average into bearish positions through this up climb. If we see a let's do from here, from the beginning of November. If people see a 28% rise in the Qs, that's going to really clear out the bears. You gotta have a lot of perseverance in order to stay bearish after a 28% rise. That's about the time that we'll start to see the market turn again and start turning to the downside and crashing. And I imagine that'll be somewhere in the same time frame as the 10-year, 2-year yield starting to normalize again, as well as PMI starting to pick back up again. Okay, so that's the game plan. And what happens today exactly? Well, I'm not really sure. I'm just going to continue to use the 1 minute and 10 minute relative strength indices to enter into bearish trades. Even though I do have a bullish bias, the trend is down, and so that is going to be the most probable direction to look for money making opportunities. You can see the down moves are more powerful than the up moves, except for this one day here on the Fed speak day on Wednesday, the 30th of November. Otherwise, the down moves are much more powerful. So anytime we get into overbought conditions at the same time, well, I should say anytime that we're coming out of overbought conditions on the relative strength indices on the 1 minute and 10 minute, that corresponds with coming out of oversold conditions on the VIX. So anytime these four charts line up so that the VIX is coming out of oversold at the same time the Qs are coming out of overbought, that's when I pull the trigger on a bear trade. I am trading short term. I am trading intraday. I'm not, as of right now, I'm not starting to average into anything that's going to last more than 24 hours. Actually, I'm not entering into anything that's going to last more than 2 hours, really. And time, once I get a good idea of what's going on, whether we're going to fill this gap, bounce off the top of it, move to the top of this range, I'll know more along the lines of if I want to start swing trading. But not until then, because I don't know. All right, everybody, that's the game plan. Good luck out there. Keep your risks tight. Click like, share, subscribe. Thanks for tuning in, and I will see you at tomorrow morning's strategy session. I am out.